Experts warn that we now have multiple factors all converging at the same time that will result in a fire sale for house prices. In other words, house prices are going to be drastically marked down. I'm Biko Konstantinos, and that's what we're going to talk about today. If you'd like to be a world champion boxer, just like me, I've got Michelle Bridges gloves to prove it. Why don't you give this video a like? And if you'd love some independent analysis and commentary so you don't get knocked out by the markets, please subscribe to my channel. I'm the Floyd Mayweather of financial commentators. Just kidding. More like Jake Paul. Actually, probably closer to a 12-year-old who's never fought in his life. But what do you got to lose? Potentially the most important thing I will ever ask you. Did you get your Tay-Tay tickets? But seriously, the chaos over the Taylor Swift tickets just shows us that the economy is running still pretty hot. And this could mean more interest rate hikes on the way until people are forced to reduce their spending. Now let's hear from Mark Burris.
Joining us now, the Executive Chairman of Yellow Brick Road Home Loans, Mark Burris. Mark, as always, it's good to see you. So, a question there. If the pace of price growth persists, will that price growth persist in your view?
No.
Mark Burris! You can get fired for saying that. If we're going to keep this Australian housing Ponzi going, prices need to rise for 300% before we're going to allow another 5 or 10% dip. Come on, Mark. This is the real world, mate. Don't you dare mention house prices going down. Alright, so Mark, just like everybody else, has been a bit confused lately with Australian house price strength in the midst of continuing interest rate hikes. But Mark thinks it's just a temporary blip and the recent strength won't last. Let's see why he thinks that way.
Why not?
Well, because a couple of things. First and foremost, the thing that creates increase in price is when either one or two things occurs. First, if demand outstrips supply. In other words, we get an increase in demand, and usually increase in demand is caused by more affordability, and more affordability is created when interest rates fall. So I do not expect to see interest rates fall over the next 6 months or up to January, February next year, and therefore I don't expect to see affordability of houses at the current price increase. That's the first thing.
Alright, so first reason why Mark Burris doesn't think house prices will rise is because increased demand for housing is normally created by more affordable housing. So for example, when interest rates decline and housing becomes more affordable for more people, that creates additional demand which normally leads to higher house prices. But Mark isn't expecting any interest rate cuts anytime this year. So he's not expecting additional demand for that reason.
The second thing that can create house price increases at the same rate that we had in the last 6 months, if supply stays the same, in other words, stays very low. I'm expecting come the spring period, like August, September, October, November, December, the rest balance this year, I'm expecting supply to increase, because we've had a low supply of housing over the last 6 months. So when supply increases, house prices tend to go down, not go up.
Mark has pointed out that lower housing supply normally leads to higher prices because you've got more buyers competing for a lower pool of stock. And this creates more competition where house prices get bid up higher and higher because buyers are more desperate to get something. And Mark has correctly pointed out that we have been going through a period of abnormally low housing supply. In fact, pretty much since COVID, the number of houses for sale has been a lot lower than the long-term averages before COVID. And eventually, it is expected for housing supply to return back to more normal levels, but when this will happen is up for debate. You see, we've been through an extraordinary period of house price volatility, and now with interest rates surging, people are just more wary around selling their home, which has led to a lower stock in general. But as time goes on, we should see an uptick in supply, especially with some of the things going on at the moment.
And the reason why I think house supply will increase is because the fixed rates are going to start to bite in. We are going to have a longer enduring period. Yeah, correct. People, and a lot of people are saying, a lot of agents are telling me, people are hanging out to see whether or not this rhetoric, which we're hearing at the moment, oh, house prices are going to go up before they sell. People are hanging out for that period, and if they don't see that period, they're going to have to sell, and they're going to sell into a big supply market.
Mark is confident that supply will increase because of the effects of some of the sharpest interest rate hikes we've ever seen. So because a lot of people are only now coming off off their low rate fixed interest rates and going onto a rate that could be double or triple what they were paying, some people just won't be able to afford the new rates and will be forced to sell. And Mark thinks that many might be holding out and waiting for the best absolute house price, but eventually many will just have to bite the bullet, and that could see an increase of sales over the latter part of 2023.
Right, okay. And how much of an increase would there be? I mean, NAB now talking, I just saw yesterday, it looks as though rates will top out at 4.6%. Is that going to feed into that argument? People just can't afford to pay things back regardless of whether you're on fixed or variable?
Yeah, 100%. So, I mean, I'm suggesting that even if interest rates don't go up, lack of affordability exists. But if you put interest rates up 2 more times, like NAB's suggesting, then totally you're going to get this position where affordability is non-existent. And those people who currently have a home loan, those people who are in that position, and if they're going from fixed to variable, which hasn't actually started to catch up to us yet, it's starting to catch up now, then those people are going to be in a lot of strife and they're going to sell, unfortunately.
We're currently sitting at a cash rate of 4.1%, and many of the big banks are now forecasting additional rate hikes, with the NAB forecasting 2 more hikes, taking the cash rate to 4.6%. Now, considering a while back, many economists didn't think we'd even get above 3% cash rate, we're now over 4 and expecting more to come. And if you look at this chart here, interest rate hikes affect Australians much more than other countries because our fixed loans are only for short periods and because we have so much bloody debt into property. So even this current rate of 4.1% is too much for some people. And some people might be holding out to see if interest rates will be cut. But if they stay higher for longer, it could cause more and more people to have to sell. And when you listen to the news around the globe, you do get the sense that rates could actually stay higher for longer. We may not get a quick bailout this time. And that has the potential to change the entire sentiment around the housing market. You see, all we've really known since after the COVID stimulus and zero interest rates is crazy speculative demand, which has created a fear of missing out desperation across all of Australia. And you can clearly see that with the amount of houses going for auction, with the amount asking for best offers by a certain date, and with massive numbers attending open inspections. But the thing with sentiment is that it can change. Now we're going to listen to auctioneer and real estate expert Tom Panos really start to explain the impact of these recent rate rises.
I just want to give you an idea of what the impact of these rate rises are. Get ready for this. If we have one more rate rise, which we will be having, we're going to see a simple $500,000 loan. I'm using $500,000 because we're talking about the low socioeconomic people, the most vulnerable cohort of people. They are the ones that are being impacted, not people that have paid their homes off, right? So let's have a quick look. $500,000, your loan repayments will be $3,701 a month. They've gone up by $1,366 since May last year. On $1 million loan, which is more like it, on $1 million loan, the loan repayments are going to be $7,400 a month.
So what I find really staggering is that $1 million loan is seen as normal. And this has to be the case in places like Sydney, where the median house price is over $1.2 million. Now, when interest rates were zero, getting a $1 million loan wasn't actually that difficult. And even the repayments were exceedingly cheap. So pretty much most people with full-time jobs could have afforded it. But from then to now, there's been a staggering increase on the monthly repayments required. $1 million loan is now looking around $7,400 per month, which is around $88,000 a year. Now, considering that the average wage is around $90,000, and guess what? That's gross. So after tax, you might net $70,000 and you'd have no chance of repaying that loan. But yes, you'd normally have 2 people contributing, but even then, $88,000 per year could easily be over 30% or even 50% of your net combined income. So sadly, those who have bought recently, who've had to get large mortgages, are now basically up the creek without a paddle. And that's not a place you want to be.
We have never ever had people's loan repayments being such a big proportion of their incomes. You can turn around and you can say, hey, listen here, yeah, but there was interest rates were 18%, in 1991, 1992, they're only, 5.5%, 6%. But don't look at that. Look at people's income proportional to their actual loan repayments.
He's dead right how it's never been harder. Check out the ratio showing the mortgage size compared to the average annual earnings. Back in the 1980s and 1990s, the average mortgage size was only between 2 and 4 times the average earnings. But just recently, it's surged up to over 8 times the average earnings. So back here when interest rates were high, because the mortgages were so low compared to earnings, your repayments weren't such a large proportion of your total income. Now, if we look at loan repayments as a share of average earning, we can see that recent homeowners have a much tougher task repaying the mortgages, with a 2020 loan paying around 60% of their annual earnings to the mortgage. Now, guess what? There's been another interest rate rise since this graph was done, which would make the percentage even higher. So I'm starting to see a lot more reports and examples of buyers who paid super high prices during the absolute peak no longer be able to afford those properties. And you can see a prime example here. This property was purchased in December 2021 at the height of the speculative housing boom, when people were paying way over the asking price just to get a property, when the RBA was promising no interest rate hikes until 2024. And sadly, this here is going to be the fate of some of those properties. And even if people aren't forced to sell straight away, as time goes by, there could be more deciding to take proactive action while house prices are still very high.
I agree with what Mark Burris says, and that is if you're an owner of property and you can actually smell that there are problems coming your way, you are far better selling before the problems happen, right? Where you take control of your position, right? You take control of your position. That's what I would be doing. And I'd also be doing it for another reason. I'd be doing it because you don't want to be in the mix when it gets really rocky and bumpy and the waves are hitting people's faces and you've got a bunch of people that are selling at the same time. And that's happening. CoreLogic RP data are very clear. CMAs are happening through the roof. There is a high level of people getting appraisals, and that is the beginning. An appraisal is the beginning of someone putting their property on the market.
So Mark Burris and Tom Panos both expect increased selling from the spring quarter 2023. In their opinions, this increased supply should lead to lower house prices, which could end up seeing accelerating declines as more people take proactive action to sell early at good prices, so they're not in the position where they're forced to sell when prices could be even worse. Will we look back and see the recent strength in house prices as merely a dead cat bounce, a small anomaly in a larger downturn for house prices? Are we going to witness the largest housing downturn in our lifetimes? I'm Biko Konstantinos.